So now that we've identified the income statement, let's reflect the cash impact of this income statement, which captures a whole bunch of affiliate income. So the first thing that we want to do is recognize that if the shareholders' equity goes up by net income during the period, so we're just going to reflect an increase of 297.5. Keep in mind that we haven't identified any common dividends, but we did identify affiliate dividends. So the next question is what happens to cash? The easiest way for us to complete these adjustments is to now take a look at what's going on with cash. Let's assume all revenues are cash and all expenses are cash and tax payments are all in cash, just to keep this exercise simple. That means that up until net income before affiliates, we've flown $260 million of cash through into our balance sheet. So that's the first exercise, $260 million of cash into our balance sheet, so we can identify that. And that's coming from our core operations without taking into account any affiliate dividends. But of course, we own 25% of this affiliate, and there is one other cash impact that's happening, and that is that this affiliate has issued us some dividends. Specifically, 25% of 80 is 20. So we've also received 20 million in dividends from the affiliate. There's nothing else that we've received in cash from the affiliate. So this is the main point here. Because of accrual accounting, we've reflected 37.5 million in affiliate income. That's not how much cash we got. We only got 20 million from the affiliate. The total of 280 is the net impact to cash from this year's operations. But we're still not in balance. We've recognized $280 million in cash, and we've recognized so that's a debit, and we've recognized a corresponding credit to retained earnings of 297.5. The offsetting entry is what's happening to investments in affiliates. The investments in affiliate asset has grown by the 37.5 million in affiliate income. And the thinking is, it's no longer the fair value that's appreciating the carrying value of the assets. The investment in affiliate asset is going up by the proportion share of net income that the company owns, and it's going down by the proportionate share of the dividends. And the conceptual logic here is that as a business, in this case the affiliate, as a business generates income, that is what contributes to the growth in the value of that business. But offsetting that are any distributions to shareholders of the value that's been generated. So any distributions in the form of dividends will reduce the carrying value. And so the net result here is that debits, 280 plus a net of 17.5, 297.5, exactly equal credits. So those are the offsetting entries. And that's the key to understanding equity method accounting. And this is as simple an equity method accounting exercise as you're going to see, because shortly we're going to tackle the issue of when you buy something where the carrying value is greater than the book value of the original ownership. So we're going to get into that in a moment. But this is as straightforward, and it's not that straightforward, but as far as the equity method is concerned, this is as straightforward as it's going to get. So make sure that you understand the logic underlying what we just did. So as promised, I was going to show you how equity investments are presented on the financial statements. So here we see that Google commingles both equity method and cost method securities as long-term assets on the balance sheet. So you see here marketable securities of 1.9 or 2 billion in 2013, and we see that they've identified here our non-marketable securities are investments we've made in privately held companies accounted for under the equity or cost method. So both methods are being used, both the method that we talked about before, the cost method for short-term investments, as well as the equity method, which we just addressed. These investments accounted for under the equity method had a carrying value of 921 and then 975 million. So for 2013, of this 2 billion, half of it is equity method. The rest is cost method. Now let's look at what's going on the income statement. And we see that they actually lump in affiliate income right within interest and other income. So this 530 million captures affiliate income in addition to dividends under the cost method, as well as interest income under the cost method. Now we've added another company just to give you another look at it. Like Google, Bree identifies the carrying value of the equity method investments as an asset on the balance sheet, But here they specifically identify equity interest under the equity method because there's a lot of them. BRE is a REIT, a real estate investment trust, which has a lot of joint ventures where they own 50% of another entity. So they account for that under the equity method. So joint ventures are also accounted for under the equity method because they're right up at that 50% threshold. And here you see the footnote that identifies the company's investments in joint ventures is accounted for under the equity method. And so we see it as a line item here. And lastly, for BRE Properties, it is explicitly identified separately on the income statement as well. And you see that they have $2.6 billion in income from unconsolidated entities. So this is a little easier to see where Google sort of commingled both equity and cost method. For BRE Properties, since there's a lot of joint venture income, they've identified it separately, just like in our exercise. Last but not least, since equity income is non-cash income, as we've seen, the only thing that matters is the distributions, the dividends. You see that the equity income in BRE Properties identifies it separately, so it's easiest to see. So you see the BRE Properties added back, or sort of subtracted the income, that $2.644 billion that we saw from the prior page is being subtracted in cash from operations from net income because it's non-cash. But what is being added is the dividends that BRE received. So it's not the accounting income that's recognized for cash from operations, but rather the distributions of earnings from unconsolidated entities. And dividends is typically the name for distributions of earnings